Welcome to Talk Tickers. Today, we're taking a look into the recent Q1 2025 earnings call from Sabio Holdings.
That's right.
Our goal here is to really zero in on the most important information for you, the experienced investor. We want to cut through the noise, get straight to the core results, the management commentary, and, what it all means.
Exactly. And this quarter, well, it definitely showed continued strong performance, especially at the top line. They're building on some real momentum.
But crucially, management was also pretty clear about keeping a watchful eye on, let's say, external factors, the broader economy, the political scene.
Yeah, that's a key takeaway. The numbers themselves, they paint a picture of a company executing well, capturing market share. Those growth metrics look strong. But the forward-looking comments, they definitely layered in a note of caution, potential macro headwinds.
Right, so understanding both sides, the strong execution inside the company and those acknowledged external risks, that seems key to assessing this call.
Precisely. You need both pieces.
Okay, let's jump straight into those Q1 2025 results then. What were the headline numbers?
So Sabio reported total sales of $9.1 million US for the first quarter.
9.1 million. And how does that compare year over year?
That's a 43% increase compared to Q1 last year.
Wow, 43% growth. That's pretty significant for a single quarter. Is this just a blip, or is it part of something bigger?
Definitely seems like part of a trend. This actually marks the fourth consecutive quarter where they've hit double-digit revenue growth.
4 quarters in a row.
Okay. Yeah, it strongly suggests that the strategic shift they've been making, really focusing on streaming TV rather than just their older mobile display business, it's consistently paying off.
Right.
In fact, they mentioned sales in that ad-supported streaming TV category specifically have shown a really robust 40% compound annual growth rate since 2020.
40% CAGR since 2020 in streaming. So that pivot isn't just driving growth, it sounds like it's driving accelerating and consistent growth.
That's the story the numbers tell.
What about profitability? Margins?
Gross margins did improve, came in at 61% for Q1 2025.
Okay.
That's up from 59% in the same period last year. So that suggests maybe some increased efficiency as they scale up.
Good sign. And adjusted EBITDA?
On the adjusted EBITDA front, they reported a loss of $1.6 million US.
A loss. How does that compare?
It compares to a $1.3 million loss in Q1 of the prior year. So the loss widened slightly.
Okay, why is that? If revenue and gross margins are up.
Well, management characterized this increased loss as expected, actually. And they said it's a direct result of deliberate investments they're making back into the business. Investments aimed at driving that future growth we were just talking about.
Got it. So top line soaring, gross margins ticking up, but there's consciously dialing up the investment spend, which leads to a larger near-term loss.
Exactly.
The picture seems to be one of prioritizing growth and market share grab over immediate profitability.
Precisely. The message from the numbers and how management presented them is one of strong momentum coupled with strategic investment for future scale.
Okay, let's dig a bit deeper into that performance then, and the strategy behind it. You mentioned streaming TV is a big part of the story. How did that segment perform versus others?
Yeah, the ad-supported streaming TV segment, or CTV as they sometimes call it, was definitely the powerhouse. It grew 40% year over year to $6.8 million US.
6.8 million.
Yeah.
And what portion of the total sales is that now?
That makes up 75% of their total sales mix now. So clearly the dominant segment.
75%. Okay.
But here's maybe the critical part. Management stated that their 40% growth rate significantly outpaced the estimated U.S. industry growth rate for ad-supported streaming. They put that industry rate at around 13%.
13% for the industry versus their 40%.
Right, which means Sabio is growing roughly 3 times faster than their peers in this key category.
Wow, growing 3 times faster than the market average is a very powerful indicator. They must be gaining share.
That's certainly the implication, yes.
What about the mobile display segment? That used to be their core business, right?
It did. And interestingly, mobile display also saw pretty strong growth this quarter. It increased 58% to $2.0 million US.
58%. That's even faster growth than streaming, percentage-wise.
Yeah.
Why the resurgence there?
Management attributed it partly to, more effective cross-selling across their different offerings to existing clients, and also just sustained high advertiser demand for performance-focused mobile placements. We can touch on some new products later that likely play into this too.
Okay, and management was careful to point out this growth was all organic, correct? Not driven by M&A.
Exactly. Fully organic. They listed a whole range of drivers, things like robust ad demand across different industries. And they mentioned telecom, QSR, travel, auto, tech, finance, legal. They also highlighted broader client adoption, expanding into new geographies. They specifically called out triple-digit growth in the United Kingdom, which is interesting.
Triple digits in the UK. Wow.
Yeah. And new product offerings, plus the benefits now kicking in from investments they made in previous periods. They also saw strong double-digit growth across several key U.S. offices like New York, Chicago, D.C., Detroit.
That brings us back nicely to the investment strategy. Management really emphasized they are actively prioritizing investment in these high-growth areas, sales teams, product development, infrastructure, over optimizing for adjusted EBITDA right now. Do they feel the Q1 results validate that approach?
Yes, they explicitly stated that Q1's performance validates this strategy. It's an approach they really leaned into starting back in Q3 of 2024.
Okay.
So the higher operating expenses and that resulting adjusted EBITDA loss, they see those as the direct calculated consequence of these investments designed to capture market share and build for the future.
They specifically mentioned an increase in cloud computing costs. What was the detail there?
Yeah, they noted an $800,000 increase in cloud computing costs in Q1 compared to Q1 last year.
$800K, that's substantial.
It is, but they attributed this to specific one-time investments. Things focused on enhancing data security, building out infrastructure needed for AI-driven efficiencies, and generally strengthening their core data platform.
So one-time costs, not necessarily ongoing structural increases.
That was the message. They expect these specific costs to normalize going forward.
And what about the sales force? They've been building that out significantly.
They have. The sales force has grown by nearly 50% over the past 12 months.
40%. That's a lot of new hires.
It is. And many of these hires came on board more recently, like late 2024, early 2025. So management anticipates the real substantial benefits from these expanded teams will start to show up more in the second half of 2025.
Okay.
And then continue to ramp up significantly into 2026. So the investment cost is hitting now, but the big revenue impact is expected a bit later.
It sounds like their philosophy is pretty clear then. Invest aggressively now, while they have this momentum. Grab the market opportunity, even if it puts pressure on profits in the short term. They're banking on future growth and operating leverage down the line.
That's absolutely the core message. They feel the market opportunity, particularly in streaming TV, is just too significant, and their ability to gain share right now is too strong to throttle back on investment just to pretty up the short-term EBITDA number.
Right. That would be leaving growth on the table, in their view.
Exactly. And they also pointed out, look, historically, the company often sees losses in the first half of the year anyway, followed by profitability in the second half. That aligns with typical seasonal ad spend patterns, though obviously the current level of investment does amplify that first half loss compared to maybe prior years.
Okay, let's pivot then to what they believe makes them stand out, especially in what seems like a really crowded streaming TV ad tech space. What did management highlight as their key differentiator?
Their primary differentiator, as they frame it, is their proprietary app science technology stack.
App science, okay.
Yeah, they really emphasize the power of their cross-screen graph technology and their direct integrations with media suppliers.
And how does that translate into an advantage for advertisers?
Well, they explain that this tech enables a very specific kind of advanced audience targeting. Crucially, it's targeting built from a mobile-first perspective.
Mobile first. Even for targeting on streaming TV.
That's the key insight they claim. They argued that clients tell them this approach allows for more effective audience reach and conversion compared to competitors. Specifically, it helps solve some common industry headaches around data quality, achieving scale, and doing privacy-compliant targeting in these CTV and OTT environments.
So the idea is they're leveraging their sort of legacy knowledge from mobile data to offer a different, maybe more audience-centric targeting approach in streaming, rather than just relying on, say, the content being watched or device IDs.
That's exactly it. While many competitors in CTV targeting might focus heavily on context or just basic device matching, Sabio is layering in their deep understanding of consumer behavior derived from things like mobile app usage patterns to build more precise audience segments that work across screens.
Interesting. They also talked about new product offerings contributing to growth. What were the highlights there?
Yes, they discussed 3 key new products that seem to be gaining traction. First one is Creator TV.
Creator TV, what's that about?
Management reported it's gaining momentum, and they're expanding its distribution footprint across major platforms. They view this as pretty unique because it's actually their first direct-to-consumer channel opportunity.
Direct-to-consumer, how so?
It seems to involve partnering with creators to offer content directly, maybe through apps or specific channels. This opens up potential for, obviously, new revenue streams, possibly better margins since it's more direct, and also richer first-party data insights compared to their traditional business model focused on publishers.
A direct relationship with the consumer is definitely a notable strategic addition for an ad tech company.
Absolutely. The second new product they highlighted is programmatic performance.
Programmatic performance.
Okay, they anticipate this product will start showing, decent traction in the second quarter or so right now. And they believe it could become a pretty substantial portion of their total revenue within this year.
A substantial portion within the year.
Yeah.
That's ambitious. What's the key benefit here?
The key benefit, they said, is that it brings in new money. Budgets from advertisers that weren't really accessible through their traditional managed service offerings alone.
Opening up new budget pools.
Exactly. And interestingly, this product specifically relies more heavily on mobile data capabilities, which likely contributes to that resurgence in growth we saw in the mobile display segment number earlier.
Got it. And the third new product?
That was performance marketing, which they actually launched back in Q4 of 2024. Management expects this to contribute several $million in revenue this year, 2025, and then significantly ramp up in 2026.
Several million this year, ramping next.
Yeah. And again, the overall mobile display growth we saw is partly a result of this performance marketing product gaining steam. It leverages their foundational mobile data expertise, and they mentioned improved relationships with mobile supply partners to deliver measurable ROI for advertisers specifically on mobile again.
So the narrative isn't just about shifting away from mobile to CTV. It seems more like they're also leveraging their core mobile expertise and these new mobile-first products to drive growth within the mobile segment at the same time as they expanded CTV.
Correct. It's a more nuanced strategy than just abandoning mobile.
Yeah.
It's expanding into CTV while simultaneously revitalizing and leveraging their mobile roots with these performance-focused products.
Okay, makes sense. Let's look at the financial plumbing now, the balance sheet, cash position. How did things stand at the end of Q1?
The balance sheet appears pretty solid and actually strengthening. Cash increased to $3.8 million US at quarter end.
Okay.
That's up from $3.3 million at the end of Q4 2024. So cash build in the quarter.
That's good to see, especially with the investments they're making.
Right. And they also noted that subsequent to the quarter end, so after March 31st, they received a $583,000 employee retention credit payment from the government.
The ERC money.
Yeah. So that provides helpful additional working capital right now.
And what about debt?
Their debt balance trended lower. It comprises about $1.6 million in specific debt instruments, plus a $5.1 million balance outstanding on their 3-year revolving credit facility. That facility is backed by their accounts receivable.
Right, the AR facility. Could you just quickly explain how that works in practice for listeners who might not be familiar?
Sure. It's a pretty common setup for businesses like this that have significant receivables money owed to them by clients. SBIO basically borrows against a percentage of the value of the invoices they've sent out but haven't collected payment on yet.
Okay.
Then, as their clients pay those invoices, the cash that comes in is automatically and directly used to pay down the outstanding balance on that credit facility.
So it's like using their future expected cash flow from sales to manage their current working capital needs.
Exactly. And given their client base consists mostly of large U.S. brands and agencies, management noted they have very low historical loss rates on these receivables, making them good collateral.
And did management provide any context on how those working capital flows, like the use of that credit line, typically trend throughout the year?
Yes, they did. They mentioned that typically their usage of that credit line tends to increase around the middle of the year.
Why then?
Well, it's because during that time, they're collecting cash from Q1 sales, but they're also paying vendors for services used in Q1 and Q2, plus navigating that historical pattern of first half losses driven by seasonality and currently those higher investment levels.
Got it. So cash outflows might exceed inflows mid-year.
Potentially, yes, leading to higher use of the facility. Then they expect the balance on the facility to decrease towards the end of the year, as the second half usually sees the company become cash flow positive due to stronger seasonal ad spend, especially in Q4.
Okay. And how do they enter this year compared to previous years?
They highlighted they entered 2025 in a better position on that credit line compared to prior years, starting from a lower outstanding balance, so more headroom.
Good context. Okay, looking ahead now, what was management's outlook? Did they give specific guidance?
They didn't give specific numerical guidance for Q2 or the full year, which is pretty typical for them, but management definitely expressed confidence. They stated they are on track to surpass their record performance from 2024.
Surpassed 2024's record year.
Okay. And they specifically expect those double-digit consolidated revenue gains to continue into Q2 2025.
So, continued strong growth expected in the current quarter.
Yes, and they believe their strategy positions them to sustain growth through the entire second half of 2025 and well into 2026.
Any specific tailwinds they mentioned for the rest of the year?
Yes, a specific tailwind they highlighted for the second half of 2025 is the anticipated high-activity U.S. election cycle.
Ah, the political ad spend.
Exactly. Historically, that drives increased political and issue-based advertising spend, which they expect to benefit from.
Despite that optimism and the election tailwind, they also spent quite a bit of time discussing potential headwinds, right? Macro and political ones?
Yes, they did. And this was a really significant point of caution from the leadership team on the call.
What is he?
They're seeing volatility in how advertisers are making spending decisions. It stems from broader economic uncertainty, but also, importantly, unpredictability coming out of Washington, D.C.
Political uncertainty impacting ad budgets.
It seems so. They specifically mentioned the potential impact of trade policy announcements. They even used a somewhat unusual phrase, Liberation Day, maybe referring to specific dates when policy changes could hit.
Interesting phrasing.
Yeah. And they explain this overall uncertainty is causing some clients to delay budget commitments. It's leading to what they called just-in-time spending.
Just-in-time spending, meaning decisions are made very late.
Exactly. Decisions make very close to the campaign's start date, and deal cycles are generally shortening. They were very clear this creates potential risks for revenue momentum in Q3 and Q4.
So internal execution is strong. They've got this election tailwind coming, but they see real, maybe unpredictable risk from the political and macro environment potentially hitting the second half of the year.
That's the tightrope they described walking, yes. However, they also countered that a bit by saying they feel the significant diversification they've achieved now makes them better equipped to navigate this kind of uncertainty than maybe in prior years.
How so, diversification?
Across different vertical industries they serve, across geographic markets, especially with that growing international piece, and across their broader portfolio of product offerings now. They believe this diversification helps make them more resilient, even if the broader economy does face headwinds later this year.
Okay. Management also touched on the company's stock valuation again, didn't they?
Yes, they reiterated their view. They continued to state their belief that the current market valuation doesn't fully reflect what they see as the fundamental strength of the business, its growth rate, and its future potential.
And they mentioned the share buyback program.
Right. They noted the renewal of their normal course issuer bid program. That basically indicates they see buying back their own shares opportunistically as an attractive potential use of capital, although they also reiterated their primary focus for deploying capital remains reinvesting in the business for growth.
Makes sense. You mentioned international expansion earlier, particularly the UK success. What are the concrete plans there? Where next?
So building on that triple-digit growth they saw in the UK, their immediate priority for geographic expansion is actually Europe and Asia, kind of simultaneously.
Europe and Asia together.
That's what they said,
right,
with Latin America potentially following after that.
How are they approaching Europe technologically? Will they have the full app science stack there immediately?
Not immediately. In Europe, their initial approach is to use data partnerships to enable app science-like capabilities. The goal, though, is to officially roll out the full proprietary app science technology stack there by the end of this year, 2025.
Okay, data partnerships first, full tech stack by year end. And they mentioned something about a land and expand model in Europe.
Yes, they discussed the efficiency of that model there. The idea is that establishing a sales presence in one key European market, say London or maybe Frankfurt, can allow them to effectively sell and execute campaigns across multiple European geographies. This could potentially offer some sales efficiencies compared to the more state-by-state or region-by-region structure often needed in the U.S. market.
Interesting. Okay, I think that gives us a really thorough picture of the quarter. The results, the strategy driving them, the products, the financial health, the outlook, and importantly, the risks management is watching.
Yeah, quite a bit covered in that call.
Now, before we go further, it is absolutely crucial for us to be crystal clear. The following segment is absolutely not financial advice.
Cannot stress that enough.
This part is purely for exploring interesting possibilities, based only on the information discussed from the earnings call. Think of it like a thought experiment. You should always do your own thorough research and consult with a qualified financial professional before making any investment decisions. Seriously.
Agreed. This is not a recommendation to buy, sell, or hold any security discussed. Purely hypothetical exploration.
Okay. With that very important disclaimer stated loud and clear, let's explore an outrageous but plausible trade idea you could theoretically construct, based purely on the narrative presented in this earnings call. Pitched like, say, a hedge fund analyst making a bullish case.
All right, let's hear the pitch.
Here it is. You go long Sabio Holdings. The core bet is that the market is currently overly focused on that Q1 adjusted EBITDA loss and maybe giving too much weight to those acknowledged macro and political risks management flagged.
Okay, so betting the market is too pessimistic.
Exactly.
Yeah.
And then it's underestimating the potential power of the growth drivers Sabio has now put in place. The bet is that the accelerating traction they're seeing in those key new products, programmatic performance, bringing in that new money, performance marketing ramping up as expected, creator TV, adding that unique direct angle.
Mm-hmm.
Combined with successful high-growth international expansion into Europe and Asia, plus that big predictable tailwind from the U.S. election cycle in the second half of 2025, that all these things together will create a wave of revenue acceleration and a significant, perhaps even surprising, swing back to profitability in the second half of the year that the market just isn't pricing in right now.
So the argument hinges on those calculated investments really blooming in H2. The sales force hires hitting their stride, the new products gaining critical mass, international contributing more meaningfully.
Precisely. The argument is that management's investments, while they ding the Q1 EBITDA, we're planting seeds in the sales force and product development and infrastructure that are timed to really blossom in the second half of this year and into 2026.
And the bet is that this specific company-driven momentum, plus the cyclical election boost, will prove more powerful than those generalized, unpredictable headwinds management also warned about, allowing Sabio to keep taking significant market share and maybe outperform expectations even if the macro environment stays a bit choppy.
That's the core of the bullish pitch. It frames Sabio as an unconventional play, a high-growth ad tech company that's executing a strategic pivot, launching successful new products into major secular trends like streaming and performance advertising, and getting a nice cyclical boost from the election. The bet is that these internal execution factors and specific tailwinds will outweigh those broader macro clouds management highlighted.
Outrageous. Maybe a little, given the acknowledged risks. Plausible. Well, based solely on the upside narrative that management themselves presented for the second half, you could certainly draw that line as a potential scenario.
A potential line, yes. But definitely one where you'd need a strong conviction that the company's execution and those specific tailwinds can meaningfully offset or be less impacted by the very real just-in-time spending and shortening deal cycles that management explicitly cautioned could risk H2 momentum.
It's basically acknowledging the risk, but betting the reward from the growth drivers is potentially much greater.
Exactly. And again, that's why we frame it as an outrageous but plausible idea purely for discussion and thought provocation. Absolutely not financial advice.
Indeed.
So let's quickly summarize our look into the Sabio Holdings Q1 2025 earnings call. What were the key takeaways?
We saw robust organic revenue growth, significantly outpacing the industry in their key streaming TV segment. Clear momentum from that strategic shift. New products are gaining traction and promise future revenue streams. The balance sheet seems to be strengthening, with improved working capital management noted, and calculated investments are clearly being made to position the company for continued growth.
And management sounded quite convicted in their strategy, right? Confident in their ability to keep gaining market share.
They did, yes. Even while being, I think, commendably transparent about the potential uncertainties and risks that broader economic and political volatility pose to advertiser spending decisions in the near term.
Okay. And one last time. This is not financial advice. Always do your own thorough research before making any investment decisions based on anything you hear here or anywhere else.
Understanding both the potential upside from the internal drivers and the potential downside from the external risks management discussed is absolutely critical for any analysis.
Which really leaves us with a final thought for you, the listener. to consider as you process all this information. Given management's confidence in their strategy and their demonstrated execution in Q1, can the specific growth drivers they've put in place, those new products, the international expansion, the election tailwind, can they truly insulate Sabio from the unpredictable impacts of the broader economic and political uncertainty that management themselves highlighted as significant risks for the second half of the year?
It really boils down to that fundamental tension, doesn't it? Company-specific execution versus those powerful macro forces.
Exactly. A lot to think about there. Thanks for tuning into Talk Tickers for this look into the Sabio Holdings Q1 call.